In June, India's inflation declined further to 2.1%, its lowest level in over 6 years. Food inflation was in negative territory for the first time in nearly 74 months, with pulses and vegetables driving down food prices. The Reserve Bank of India has already cut rates by 100 basis points, and the policy rate now stands at 5.5%, compared to 6.5% at the start of the year. But can interest rate go down further, or is such a low inflation such a bad thing for the economy? We have with us Aditi Nair, Chief Economist ICRA, Rajani Sinha, Chief Economist CareEdge, and Shweta Poonch, Policy Editor at Money Control, to discuss the issue more. But before I go on to my guest, let me just take our viewers through a few graphics to explain the issue. Now, if you look at it, India's inflation was at its lowest level in about 77 months, declining to 2.1%. It stayed below that period for a considerable point of time. It has been in that sense. If you look at food inflation was even at its lower level from that at minus 1.1%, and from that vegetables and pulses were actually driving down prices. Vegetable inflation was minus 19%, pulses was minus 12%, near to minus 12%. Services and core goods, on the other hand, have risen faster. They've gone to 4.99%, which is about a 24-month high, and same with core goods as well, which is 4% here. Let me first go to Aditi. Aditi, can you explain this figure for us? How have we reached the other end of the RBI's 4% mark?
Thank you, Ishan. So, it is largely being driven by the base effects. Last year, in the same month, inflation was at a multi month high, and vegetable prices in particular had shot up very rapidly in that period. And therefore, when we look at the current year, there's a couple of things. One, of course, we've got this base effect that I just talked about. And also, the normal seasonal rise in vegetable prices has been a little slower than what we see in normal months. So even if we leave aside last year, which was an aberration, even otherwise the seasonal uptake has not been as rapid this year as what it has been in several years in the past. So the combination of these two factors is leading to this deflation in food inflation and pulling down the headline CPI inflation print to what has been normally pretty elusive, which is the lower end of the 2 to 6% medium term target that the MPC and the RBI have for themselves.
Rajni, core has been moving up. It's been moving up for the last few months. What does that mean from a economic standpoint? Does it mean that the demand is healthy because core goods, the demand for goods are rising, and that's why it's leading to more inflation? Or is it more base effect in that scenario as well? Because I remember core was lower around last time.
So, Ishan, yes, you're right. If we look at the core inflation, that has been rising, and in the last month, it touched around 4.4%. But I wouldn't say that's concerning, nor would I say that it's a reflection of demand in the economy. Because if you look at core inflation, it's not broad based. It's very confined to a particular category. So we are seeing high inflation in personal care items, but otherwise, if you see inflation, core inflation is also not high in other items. So it's mainly, gold and silver price spike that we have seen in the last year or so, that has been pushing up core inflation. But otherwise, if you look at the demand side push on core inflation, that's still not high. So I wouldn't say that core inflation is a reflection of demand side pressure picking up in the economy.
Shweta, you've been writing about political economy for a long period of time. What does this low print mean from a political economy perspective? Elections are due in Bihar in a few months, and there are elections across the country also. Would the government celebrate this as a win scenario?
Right, Ishan. No, so this is a very good set of numbers from a government perspective, because like we spoke about, that this inflation has hit a 6-year low, which is very, very impressive, and a whole host of factors have worked, for bringing down inflation. Some of it that we've alluded to in, Aditi spoke about it, Rajni spoke about it. But I just want to bring out two things that the government has also done in terms of import duties on pulses, and that's something that they had hiked last year, but they brought them down this time around. The way the government has managed oil prices. again. So all of that is reflecting now in the inflation numbers, and it augurs very well for the government because we have Bihar elections coming up in November. And overarchingly speaking, the effect of it will be felt in the economy as well going forward. It could lead to a boost in consumption, something that we've seen lagging in the last few quarters. There could be a rate cut. If all goes well, there could be a rate cut again, a feel good factor for the government, for the economy. So all these things augur well for the government, Ishan. So I'm sure more than you and I, if there's anyone who's celebrating right now, it's the policymakers sitting in North Block, South Block, and of course, Lok Kalyan March.
Aditi, talking about Shweta touched on this aspect of RBI cutting rates. Is this a joyous moment for the Monetary Policy Committee at least, or does it make the ground more tough for Monetary Policy Committee? They were expecting your forecasts are much lower at 3.5% for the year. So, what does it do for the August MPC meet, and in future, do they have to cut? Do they have room to cut also? Given that the pass through has not happened across the existing cuts also.
So, Ishan, the sense I have is that the MPC had front-loaded rate cuts. They had done 50 basis points of rate cuts in June, with the CPI inflation being projected at 3.7% for the full year. Now, even at that time in June, we thought that CPI inflation was going to average only around 3.5% for the full year. And yesterday, we were surprised by how sharply the June print had fallen. Now, my expectation is that July will be the bottom. We might get a sub 2% CPI inflation print for this month. And then it's going to gently trend upward through the rest of the year and end up above the 4% handle in Q4 of FY26. So for the average, I'm still looking at 3.5% or even a tad lower than that. Now, my sense is that there is room for one more rate cut, 25 basis points. Earlier, we thought that it's probably going to come in October after the front loading that the RBI has done and the MPC had done. And there are a couple of reasons why we thought in June that there will be a pause in August. One, we thought that they might want to wait and see how things pan out, particularly with the monsoon. By the time the October policy comes around, the monsoon will be over and we will be in a much better position to understand its impact on multiple factors, crop output, rural demand, etc. And secondly, we also thought that the CPI inflation, they'll want to wait and watch and see how the trajectory is. And thirdly, in terms of the GDP growth print, we had the Q4 print at the time of the June policy, and we won't have the Q1 print in time for the August policy. We'll only have it by the October policy. However, seeing as how fast the CPI inflation did fall in June, and the likelihood that inflation in Q2 is going to be quite a bit lower than what the MPC had projected, I do think that they're going to have to revise the Q2 and the full year forecast downward. And therefore, we're not ruling out a rate cut coming in as early as August, carrying forward the theme of front loading.
Rajni, what's your sense on this? Are we preparing for a rate cut soon? Is it downwards to
Ishan,
3.5%?
I feel that when RBI last time front loaded the interest rate cut, they were kind of expecting a moderation in inflation to happen, though the moderation has been steeper than what was probably being anticipated at that time. And we are likely to get overall inflation for the year at lower than RBI's projection. Nevertheless, I feel that given that RBI has already done the front loading, and inflation moderation is playing out as anticipated, though a little steeper than that. Hence, I feel that RBI will not cut rate further. They have kept when they move to neutral stance, the whole idea is they have kept the window open only if growth weakens from what is being anticipated currently. RBI, if you look at their projection, they're expecting 6.5%. If growth turns out to be weaker than what RBI is expecting, and they get those signals in the next few months from the high frequency indicators, only then would RBI go for a further rate cut. Otherwise, I think they have taken care of it in the last meeting.
Aditi, let me come to you before I go to Shweta on this part. A rate cut at this point of time, would it help in terms of the growth perspective? Because given the uncertain environment, would people take up loans? Is there a demand for that kind of a scenario also in the country? So, how would a rate cut help? If you can explain for our viewers.
See, in the current situation, we've got domestic demand drivers which are broadly intact. The bigger problem is the global uncertainty and what we're getting in terms of a lot of volatility in terms of trade policy as well as geopolitics and the implications that those have had for things like commodity prices. But more than that, for sentiment in general towards the investment side. So where we think that the overall global issues are going to have an impact on the domestic economy, the biggest sense where we think that there is going to be a negative fallout is going to be on the private investment cycle, and that is somewhere that in a normal situation lower rates may have helped, but maybe they will not necessarily help kick off the private capex cycle in a broader way this time around. There will probably still end up being some delay. However, when we look at what the lower interest rates would do, they would bring down the rate of existing loans. So the interest rate that consumers face, for instance, on loans they've already taken, on their EMIs, etc., there would be a positive impact over there. And that is something that could actually push up the consumption side and help to stabilize growth in a sense when we have so many external headwinds. And ultimately, it's only when there is a clear visibility on consumption will a lot of the consumption facing sectors actually go in for capex. So it could end up having a positive impact. The other thing we're hoping is that there is headroom for double-digit growth on the state government capex side, and even on the government of India side, while the capex last year was higher than what they had penciled in, and the headroom seems very low compared to the budget estimates in terms of the growth rate. However, there have been some revenue streams which are now looking like they're going to be higher than what was budgeted. So we think that there is scope to expand expenditure by about 80,000 crore above what was targeted for this year. If that gets basically funneled towards higher capex, then again, even on the central government side, we have scope to have a double-digit growth in capital expenditure this year. An early kickoff of these drivers of growth would definitely help to stabilize growth rates in the first half of the year. We have to wait and watch and see. I mean, certainly for the first 2 months of this fiscal, Government of India capex numbers are looking good on a low base. So how the momentum continues through the monsoon months, that is something that we're waiting to see.
Shweta, I'll bring you in on this point because we've been talking about capex and the consumption part. What is your reading? You've been talking to a lot of policy guys on this regarding the consumption cycle. We've talked about how urban consumption has been a problem somewhere, right? The lower segment and the higher segment. We'll take that to Rajni and Aditi as well. What is your reading till
Right.
now?
Right. So, if we were to look at how consumption is panning out, and if you just look at the numbers that have come in, we see consumption, especially at the lower end, slightly somewhat subdued, but higher end products, we've seen a fairly robust consumption there. So, and that is something that the government has been also mindful of. But I do think that timely monsoons, could potentially change that, and low inflation. So these two things together could augur well for the rural economy. So again, a lot of people have spoken about the K-shaped recovery, and we have two economists here who can speak in greater detail about it. But that is something that has been on the minds of policymakers: the K-shaped recovery, and the widening gap, the widening consumption gap between those at the bottom of the pyramid and those that are well to do and so on. So a good monsoon, a potential rate cut, and a low inflation. In fact, I was talking to someone. I won't name the bank, but it's a global bank, and they said that their full year forecast could actually be 3.2%, which could be lowest inflation since we've seen since 1989. So if that were to happen, it seems like this year we could actually see a bit of a turn in our consumption story, and it could be a feel good factor in the economy. Nishan?
Uh, Rajni, taking that point of rate cuts, can further rate cuts help? To within that paradigm, if I were to ask you two more questions related to that, uh, is there a dichotomy in urban consumption, or is there more premiumization that's happening, right? And the second part of that question is, how is a rate cut more important, or is the GST rationalization at this point of time more important from that perspective? Because the government has already delivered on the tax front. So what's the more important aspect in this?
Okay, so I'll take the consumption question first. So, like Shweta highlighted, in the near term, there are some positives for consumption. We are seeing inflation coming down. Monsoon is good. This year, the income tax burden has gone down. So, these are definitely near term positives for consumption. But there are some longer term concerns which I would like to highlight on the consumption front. So, if you look at the employee cost for corporates, that has been coming down. And that, I wouldn't say the growth has been coming down, the growth has been moderating. So, we had done a study with some sample of some 700 companies, listed non financial companies. And what we observed is that the employee cost has in FY25 has moderated to around 7% from growth of 10% between the period of say FY19 to 24. So there is some moderation in employee cost, and more so the worrying part is that specifically if we look at IT sector, the employee cost has gone down quite significantly. The growth has gone down to 5% from a high of 15% that we had observed between FY19 to FY23. So, what I'm trying to highlight is that if the employee cost is going down, that is a reflection of what's happening to household income. So, we are concerned on that front. And it's not just, even from PLFS, if you look at what is happening to wage growth, in real terms, wage growth has been very, very feeble in the last few years. And another aspect that we checked is as to what is happening to headcount specifically for IT sector. Because IT, if you look at urban consumption, IT is like the backbone of urban economy. A large part of urban population is employed in the IT sector. And there we are seeing that the headcount was kind of flattish in FY25. We looked at a sample of five major IT companies, and we observed that the headcount was flattish in FY25 and it had seen a contraction in FY24. So the aspect that I'm highlighting is that household income is getting impacted somewhere. And that is also getting reflected in what we are seeing on the consumption front. So this dichotomy that we are talking about, the aspect that we are talking about as to the higher income category, while we are seeing consumption spending happening, it's weak in the lower income category. That's also kind of being, this argument is being supported by the data that we are seeing on household income. So these are some of the longer term issues that we need to handle in terms of wage growth, in terms of job creation. This is important to ensure that the consumption growth remains strong in the economy, because only when the consumption growth is strong will private investment also pick up. And to add to all the concerns on the consumption front, the other concern on private investment is the whole concern around the global uncertainties that we are going through. So I think it's a combination of these two factors which is putting pressure on consumption and investment. But having said that, yes, there are some near-term positives for consumption that should be supportive of consumption. And on the investment front, we are seeing good investment by center as well as state that would also be supportive of overall investment in the economy. But yes, these are some of the broader issues that needs to be handled. Now coming to rate cut and GST rationalization, I would say that rate cut. There's only so much that rate cut can do, because when it comes to pick up in private investment, it would also be dependent on whole lot of other factors. The important factors being what's happening to the demand in the economy, what's happening to economic, how much of economic certainty is there. So those are the factors that will also have a strong bearing when it comes to private investment. So a rate cut may not be the only way right now to further support growth in the economy. Hence, I feel that RBI could, like I mentioned earlier, RBI could wait unless growth situation worsens from what we are expecting right now. If the global uncertainty becomes much more severe and we start fearing that growth could go to close to, like, say, 6% or so, then RBI could look at the further rate cut. GST rationalization, it depends in what form it comes. But yes, any kind of further relief to the consumers will definitely push up consumption in the economy. But it really depends on in what form the GST rationalization comes. And the other aspect that the government will have to be mindful of is what happens to, central finances are in good shape, but they'll have to take care of state government finances also. So those are the two aspects that we'll have to look deeper into for GST rationalization.
Aditi, I was looking at the IIP numbers and within that the consumer durables and non-durables, and they have been negative. There has been contraction in both consumer durable and non-durable sector in the last month. Uh, what do you make of that from a urban consumption perspective? Rural, we know if a good monsoon is there, probably it would pick up. What do you make from that? And from the GST rationalization point, how much would that help in terms of boosting growth? Because of course, our economy, private finance, final consumption expenditure is about close to 60%. So how does that play into the equation in terms of growth?
So, Ishan, firstly, the IRB is highly dated. So, we have to take what it's telling us with a pinch of salt because the base pertains to such a long time ago that a lot of what we're consuming right now was not even, conceived at that point in time. So, not the best indicator of what's happening with consumption. Secondly, of course, imports as well are there. So, it's not only domestic production that is going into consumption, but imports as well. And therefore, the picture that we need to sew together is much wider in terms of urban consumption than simply what the IIP data is telling us. I'm not going to repeat what Rajni said. Broadly, to my mind as well, consumption is very uneven. There are sectors that are doing well, where wage growth is high, where headcounts are being added, and we are seeing, you know, those sectors churning out possibly better consumption opportunities for the people working there. Even within urban consumption, if you look at an income-wise distribution, I think it's also the middle income group which is struggling quite a lot with the high inflation that we saw last year and things like growing children, aging parents. A lot of it also adds to your spend which is required. It's not just a matter of inflation on a fixed basket of goods. It's how your own consumption has to change as your family needs change. So I don't think it's just a matter of high income being supportive of consumption, low income being a problem. I think the middle income group has also had quite a lot of issues to deal with. And rate cuts, we started the year thinking we'll have 50 basis points of rate cuts. We already got 100. We're waiting for the final 25 basis points rate cut. Whether it comes next month or it comes 2 months after that, I mean, that's what we're debating right now. So in a sense, we got a lot more than what we hoped for at the beginning of the year. So this has certainly been a supportive factor. The income tax relief again that we got in the budget, that's setting us up well for the kind of uncertainty globally that erupted in the period after the budget, in a sense. So from March onwards, we've been in a new heightened phase of uncertainty. GST rationalization certainly, but it's not something that will happen very easily or very quickly. As Rajni said, I mean, you have so many states to take on board. Their own fiscal situations are very, very disparate. Some states get a lot of tax from the center because of the way that the Finance Commission norms are set up. Other states are much more dependent on their own tax revenues in their overall revenue pie. These things are going to affect how they're going to think through the GST rationalization process. And of course, we have the new Finance Commission that is currently underway. The report is expected to be tabled, I suppose, next year before the budget. and that is also going to guide how the state's revenues are going to look like from FY27 onwards. That's something they will also want to keep in mind. And then beyond that, we have the Pay Revision Commission that will be set up and present its award. So that over the slightly more medium term is, and again, something that would be positive for consumption. But I think right now we're still in a period of flux. There are things which are supportive, like the rate cuts, like the income tax cuts, like the monsoon, and hopefully we'll have a clearer picture in a couple of months.
Shweta, what's the thinking on the GST rationalization part? We've seen stories crop up everywhere. Yesterday there was one, I think, in the Indian Express, which was talking about Amit Shah taking a meeting to drive a consensus on that part. We've heard about the 12% rate going, the tax slab. But I was talking to somebody, they were like, if it goes, how do you place the items is an issue. Which items do you move to the lower rate? Which items do you move to the higher bracket? Meanwhile, the revenue neutral rate has come down to about 11.5%. So, what's the government's thinking there, and how is it planning out this thing?
Right, Ishan. So, for all the factors that we look at in an economy, I think inflation probably stands out as one good luck factor because GST rationalization is a long pending reform. And Indian Express did that story about Mr. Amit Shah driving the negotiations. And why did he have to step in? It's because it's such a politically contentious issue. And that's what the Finance Commission is also battling with because I was speaking to some officials there as well. They've been going and meeting state leaders who've been coming back with a slew of complaints. So GST rationalization is a big reform which will take a lot of political heft to go through. Now the reason why GST happened was also because Mr. Jaitley had that political clout to get the state leaders on board. And now things are a little more tricky with the opposition ruled states, with elections coming up in some of the states. So whether the government will be able to push this forward in the next, say, 2 to 3 months really remains to be seen. Also, how much of a priority would this be for the current administration? Because they're dousing several fires at the moment. You have a monsoon session coming up, and a lot of questions are going to be asked of the government in that session. You have the plane crash, you have the Pahalgam attacks. So inflation really is their only hope at the moment, where they can talk about that we managed inflation and look at the numbers that have come in. But overarchingly, Ishan, to answer your question, GST rationalization is a reform that's been in the pipeline for a really long time. The 12% rate, we've done several stories around it. But do we see it as a number one priority of the government at this point? I don't think so because you have several other things that are working out simultaneously of the Indo-US trade deal. So there's a lot that's going on at the moment. So I don't see much movement on that, at least in the next quarter. But one never knows really what will happen. But yeah, so politically it's a very very tough one, and you need somebody like a Mr. Amit Shah to push this forward.
Rajni, moving to you, there are two aspects. One is the wholesale inflation also coming down. That was a negative this time around. What does that do to the nominal growth numbers and then the associated debt to GDP or the fiscal deficit ratios? We've got a surplus dividend from RBI, which is going to help, of course. And the second aspect is, do you see your inflation forecast getting revised downwards because the government just removed the import duty, lowered the import duty on oil imports, which was a high inflation item, even this time around double-digit inflation. So how do those two questions round up for you?
So, firstly, to answer your question on nominal GDP growth, yes, with CPI inflation and WPI inflation turning out lower than what was being anticipated earlier, this would bring down the nominal GDP growth. It's difficult to say as to overall what would be the impact of that on government finances on some of the ratios that we look at, fiscal deficit and debt to GDP. Because so far, we don't have much data on government finances as yet. So it's difficult to form a view for the whole year. But broadly, if you see the track record of the government, they have been able to achieve more than what they have committed on fiscal consolidation front. So, and if I look at the on the growth front also, like I said, right now we are in a situation where the growth, it's not a very worrying factor, the GDP growth, while there are some concerns. But I would say, compared to say 3 months back, when we were very worried about the geopolitical and all the global trade policy uncertainties, that has kind of abated, though we are still uncertain. But the impact of that on global growth and India is likely to be less than what was being anticipated earlier. So, in that sense, if the growth momentum is not very adversely impacted, I think government will stick to its will be able to stick to its fiscal consolidation path, and hence a little lower growth also is not going to very adversely impact these ratios. Now, coming to your question on our projection for inflation for the full year, we have lowered it down to around 3.5% for the full year average. But yes, we will have to closely watch as to what's happening to specifically to food price inflation. And because the momentum is turning out, the fall in prices is turning out sharper than what we were anticipating. But right now, our projection is at an average of 3.5% for the year.
Aditi, on the inflation aspect, is there room to go down further? But I was looking at month-on-month increases in vegetables. Actually, are seeing quite an increase in month-on-month basis. Tomato is up about 37%, potatoes up about 5%, onions about 2%, coconut oil is about 10-12%. And how does the government reducing the duty on raw processed food oil, raw food oil help in this, edible oil help in this regard?
So, Ishan, if I talk more broadly, the month-on-month increases that we're seeing right now are normal for this period, and we had a very muted uptake through the early part of the summer, and then going into the early monsoon, and now we're kind of getting to what is relatively normal for this period. So, I'm not terribly worried. Right now, my inflation average for the year is actually tracking a little below 3.5%. But I'm not lowering it because, like Rajni said, the momentum is turning, and we want to see how things move over the next couple of months, a couple of weeks, before taking a call on whether actually we need to lower the inflation forecast below 3.5%, or is it fine over there. Now, on the nominal GDP question, I think the problem is more for Q1 itself. So, if you look at the averages for WPI and CPI for Q1, they're quite low. So, the sense we have is that the nominal GDP growth is going to come down from about 10.4% in Q4 to between 8 and 8.5% in Q1. So, there's going to be a very steep fall between these 2 months. However, going forward, as the CPI inflation trajectory starts turning upwards, which is what we expect for it to actually hit around the 3.5% average for the full year, the impact on nominal GDP growth will be less accentuated in the later quarters. So what we feel is that Q1 is where we're going to have the maximum impact because the readings for both the CPI and the WPI are so low in this quarter. But it's going to kind of turn around and not have so much of an impact on the later quarters. Having said that, we are looking at a nominal GDP growth of just around 9% for the full year. Now, there is a silver lining, which is that the GDP absolute numbers for last year were actually revised above what had been pegged into or baked into the budget. So, even with a slightly lower nominal GDP growth, we're not looking at the FY26 absolute nominal GDP being significantly lower than what was mentioned at the time of the budget. So, in that sense, the denominator is looking largely intact. On the numerator side, the positives from the higher RBI dividend, etc., I've already spoken about. We think that there is a revenue cushion, and if anything, we think that the government of India has the scope to be able to increase expenditure beyond what they budgeted and remain at the fiscal deficit to GDP ratio which they had targeted in February.
Shweta, last question to you. Is the government looking at these scenarios of actually bringing down the fiscal deficit ratio much further, or is it actually thinking about this RBI dividend more from a spending perspective that let's do capex right now when we can do it?
Good question, Ishan, and I wish I had a direct answer for you on that what the government is thinking of whether they'll use it to boost capex or to keep their fist under check. But largely, if you see, the government has been spending on capex, and that's been their that is how they've really gone about it, and they believe in being fiscally prudent. So at this point of time, with Bihar elections, and then you have elections next year as well, I would see that capex spending would stay up, because we know that the private sector has been somewhat reticent, and the uncertainty is going to continue. And until there's a boost in demand, we don't see the private sector really stepping in. So the government will, in my assessment, continue to step the pedal on capex spending, because that is one sector which has a multiplier effect on the economy, and that's something that we really need at the moment. Also, that's one sector which will give you jobs, which will give you incomes. And keeping the politics aside, at a time when hiring projections from companies are looking fairly muted, government has to step up to be seen as a key employment generator. We've seen Prime Minister Modi announce so many Rozgar schemes. He's going to be in Bihar, handing out Rozgar cards and so on. So all that, where are the jobs going to come from? Those kind of jobs are going to come from construction activity. So that's where I see the government really focusing on. But having said that, I don't think it's going to be a decision between keeping capex going and fiscal deficit. I think they're going to try and pursue what they have done in the past as well. Keep the capex up, but keep the fisc under check as well.
Thank you. Thanks a lot. Thank you, everyone, for coming on the show. It was great having you to discuss this. We'd love to have you again back soon. Uh, Thank you.
Thank you, Ishan.
Thank you. Bye.